So I've been slated with the most exciting topic of the day, insurance and managing risk. And I will say that everybody in training right now, the largest opportunity you have in front of you is this transition to practice. But it is a very hectic time. I've been doing this for 14 years, working with doctors exclusively, all the way from residency until retirement. And you're getting used to potentially a new geographic area. You're getting used to potentially new state and federal tax brackets. You're getting used to new work situation, colleagues, everything else. And being prepared for that transition is really a big deal. We see all the time these common pitfalls that physicians fall into. And being prepared for that transition, being educated, so when you make that transition, you're ready to go, is really a big deal. One area that gets vastly overlooked by residents and fellows and younger doctors is the insurance and the risk management. And I think part of the reason for this is they feel like, well, I don't really have many assets to protect. I don't need to manage this risk very much. But as I'll go through today, that's largely untrue. Risk management is essentially the practice of forecasting and evaluating financial risk combined with the identification of procedures to avoid or minimize their impact. In other words, it's taking a look at the assets that you have, determining which ones that you can retain the risk of losing and which ones we need to transfer the risk of losing to either an insurance company, trust, a corporation, some sort of an entity that manages risk. Now, looking at the 4 stages of risk management, we're going to go through these. We're going to mainly focus on number 4 today. But number 1, taking inventory of assets, identifying the risks to those assets. Number 3, evaluating the options to manage those risks. And number 4, implementing the strategies to make sure that those risks don't pose a threat to your financial future. First thing that we look at, taking an inventory of our assets. So on this slide, we've got personal and business assets, and oftentimes there are both in the field of radiology. In radiology, we have a lot of clients that are employed via the VA or hospitals, W-2 employment, that also do teleradiology on the side. So they have the 1099 income as well of a business owner. So you do have personal and professional liability there. And so we'll talk about that when it comes to personal and professional lawsuits as well. But taking a look at the personal assets as well, this is an area that I think mistakenly physicians are not planning for adequately in one of these areas. So I've got an audience response question. So the question posed is, what is the largest asset for most physicians? A lot of people, they think of tangible assets as being their largest asset. So kind of keep that in mind as you answer this question. 90% of you got it right. It's income. And when you think about a present value of future income, that is not only what you're depending on for all of your future aspirations, college savings, retirement planning, it's what you're depending on for current expenses, keeping a roof over your head and groceries and bills. But it's also a big target if you get sued. A lot of people, when we talk about asset protection, the thing that comes to mind is, well, I don't have any assets to protect. Well, a plaintiff's attorney is not going to view it that way. If you've got a future income of $10.5 million ahead of you in your 30-year career, if you're making $350,000 a year, that is a huge asset to go after. So keeping in mind that your income is arguably the most important asset to protect, that's really important. Now, as far as what income represents, as I mentioned, the future goals and considerations, the current expenses, but also imagine after this time that you've put in and the money you've spent on med school, residency, fellowship, on into practice, if you can't earn the income of a practicing doctor. It represents the sacrifice that you've made for you and your families to be able to earn the income that you've been trained for. Now, second step, identifying the risks. So we break this into 2 different categories, inside and outside risks. Inside risks being things that could impact your ability to earn an income, outside risks being the risk of other entities coming after your assets. Third thing, evaluate the options to manage risks. So we've got kind of 4 categories of personal risk tolerance. And this is where we're looking at retaining risk versus transferring it. So we've got the category of the risks that we're willing and able to retain the risk of loss on. I've got a 90-pound chocolate lab that is healthy as a horse. We haven't had many health issues. We've had him in there for a few things. He ate the stuffing out of a pillow, and we had to have a little procedure done to get that taken care of. But I'm willing to self-insure the cost of veterinary care. Every time I go to the vet, they try to sell me on their pet insurance. I've got the emergency fund set aside to do that. So I'm willing and able to retain the risk of that loss. There are assets that you should be unwilling and unable to retain the risk of loss. So that's that bottom right category. So insuring a home, a car, business, your income. There are also some risks that some people are willing and unable to retain the risk of loss. And this is what we kind of, we don't advise people to do. Obviously you have to insure your car and home, but I had 2 clients in the last month that have passed away. One chose to secure all the proper insurances, and the one that did went through a long disability with cancer and then eventually died. And their family was well taken care of during the disability, and then will be well taken care of now after they passed away. The other one did not. Against our advice, they used tobacco and wanted to wait until they stopped using tobacco to apply, and so kind of went against our advice and decided to self-insure it. Well, 3 kids and a family. The generation above them that she was supporting, and now they are kind of left out in the cold, unfortunately. They had a little bit of she had a little bit of insurance through work. So income is not an asset that you want to retain the risk of losing. It's simply too large of an asset. And then there are assets that you can be unwilling but able to retain the risk of loss. So I've got 2 boys, ages 6 and 8. I actually buy the iPhone insurance, even though I know that I can self-insure that cost. I've had to use it a few times because of my kids. The most recent, I came home and lost track of my phone and found it later in a pot of spaghetti sauce. So it's sometimes you don't want to retain some of those risks. Now, implementing strategies to manage risk. I'll start with the inside risk. Once again, is the risk of something happening to you that could inhibit your ability to earn future income. What risk poses the largest threat to your income in your working years? I'll leave it up for another 5 seconds or so. All right, C. 88% of you were correct. Social Security Administration reports that 1 in 3 people are disabled for a period of 90 days or more within their working years. So more particularly long-term disability. Short-term disability, you can retain the risk of being disabled for a month or 2. You don't need to buy short-term disability insurance if you've got your emergency fund built up. Long-term disability, if you're disabled for a long period of time, think about it this way. If you die, your income and your expenses both go away. If you get disabled, so this is for the single people too that are not supporting a family, your income can potentially go away, but your expenses continue or are oftentimes larger. My mother-in-law passed away from ALS in 2008. It was a 5-year-long battle. In the final 2 years, the cost of care alone was close to $60,000. So it's another conversation not just to have with yourself, but also with your parents. Is, Mom, Dad, what do you want to have happen if something happens where you need extended care? Do you want to come live with us? Do you want to have assisted living? Do you want to stay in your own home and bring in a caregiver? Because if that's not planned for, that can put a big wrench in your own plans. Now, looking at long-term disability insurance, we'll go through a couple of different things, mainly the types, and then also when to secure coverage. Now, comparing individual disability or private disability insurance and group disability insurance, it really comes down to how the insurance companies manage risk. When we talk about group disability insurance, what that's referring to is what you have through your employer. Employer-sponsored disability insurance, think about it this way. If you're employed, I live in Arizona, the largest employer in the state is Banner. It's a hospital system down there. And You think about Banner or Kaiser or the machines of the world, the youngest, healthiest employee of that institution has the exact same disability insurance as the oldest, unhealthiest employee. They cannot discriminate based on ERISA laws. They cannot discriminate the coverage that they afford to their employees. So the way that they limit their risk in a group plan is with their definitions, the policy language, policy ownership, and benefit integration and taxation. Starting with the definition of disability. Most group plans state that if you can no longer work in any occupation, so if you're 100% totally disabled from any occupation at all, we'll pay out. If you can work 20% of the time flipping burgers at McDonald's, we won't pay you anything. So it's an all or nothing policy, and the policy language, a couple of things to touch on there. Self-inflicted injury includes putting yourself in any hazardous situation. A couple of examples with our clients. One of our clients was putting Christmas lights on his roof a few years ago, fell off, broke his back. They said, the group plan said he put himself in harm's way, we're not going to pay out. One of our Banner clients in Arizona was in a car accident, and they considered that a self-inflicted injury because he put himself in the hazardous situation of driving a car. So it's very difficult to get a group plan to pay out. It's basically insurance for it if you are totally disabled because of an illness. So they're not all created equally, but in general, it creates a false sense of security to rely on the group plan. You also don't own that policy. So if you change employers, it doesn't come with you. Also, you could have the same employment and the group could decide to change or remove the plan altogether, and then you're stuck with worse coverage or no coverage at all. And then lastly, benefit integration and taxation. If you are lucky enough to receive a benefit, it is offset or reduced by any other sources of income that you're having. That could be a distribution from your 401k, it could be Social Security, anything else, and it's taxed. So on top of all of those things, a good chunk of it still goes to the IRS. With private disability insurance or individuals, so getting it on yourself, the way that they manage their risk is by charging more for it. And number two, underwriting. So they ask you your health history, they look at labs, family history, your hobbies, and really it's a difficult insurance to get. And so they are really looking to provide coverage for those that have very few health issues. The definition of disability in those plans, though, is that it's specialty specific own occupation, and this is only with the companies that Ross mentioned earlier. So what that means is if you're no longer able to do interventional radiology, but so you're disabled from interventional radiology, but you're able to do general radiology, you'll receive the disability income, the full disability benefit of a disabled interventional radiologist, in addition to the income that you're receiving being able to do general radiology or teaching or consulting or anything else. And there's no limit on that. That is the most important thing to look for. There are a lot of companies that say their policy's own occupation, Northwestern Mutual and some others. It's not. It's a transitional definition or there are exclusions on it. Only the companies that Ross put up there are the ones that offer specialty specific own occupation. And depending on the state you live in, it may not be all of them. California, there are only 2 companies that offer it. Policy ownership and portability. This is a huge one. Not only can you move state to state, job to job, but if you are in a general radiology residency right now and you're planning on doing a fellowship, the more specialized you get, the more expensive the coverage gets. If you lock it in at your specialty now, you will preserve that lower rating, not just on the coverage you get now, but also on all the future coverage that you buy. And you're able to get that without underwriting as part of the policy when your income, once you go into practice. Benefits are not integrated and they're tax-free as well. That's a big difference. Why to secure it while you're in training? Well, even though your income is much less right now, it means the same things. It represents, once again, all the money and time you spend on training, your future plans, and your current expenses. You're your youngest, healthiest self right now. Well, not always the healthiest, but you definitely are the youngest self you'll ever be. So taking advantage of that and locking in lower rates now is advantageous. Also, there are training and gender discounts. Don't shoot the messenger, but females, once you're in practice, they pay double the cost for disability insurance than males do, and it's mainly for maternity-related disabilities that they have higher rates. There's one company left, and in some states more than one, but in general, one company left that is offering females the male rates when you secure it in training. And we met with a representative of that company a few months ago, and it's likely that within the next year or two, they're going to be doing away with that discount. So that is one reason to lock it in, but even for the guys, you get a lower cost if you lock it in while you're in training. Other considerations: once you start your practicing job, a disability insurance company is going to look at your coverage through work and your income and develop an offer based on that. If you have coverage through work that covers a big portion of your income for a disability, even though it's unlikely to pay out, they'll take that into account with how much they're willing to offer you. So if your group covers 50% and they will only insure up to 60, you can only get 10% on the private side. If you get it while you're in training, they don't take your income or group coverage into consideration. They just offer you a resident or fellow package, typically $5,000, $6,500, or $7,500, depending on your year in training and specialty. And then once you get into practice, your group plan stacks on to your private plan, and you can oftentimes get more private coverage as well. So you can get 100% of your income typically covered or close to it. Now, moving on to life insurance. Not a lot to cover on this. A couple of things to consider in how much you purchase. Main thing is, how much of your income do you want to replace and for how long? We've had clients that have come to us and they say, I want to be able to replace all of it forever. I want to be able to replace half of it for 10 years or all of it for 10 years. A very general rule of thumb, if you want to replace income in perpetuity, for every $50,000 of income you want to replace, that's $1 million of life insurance, because you're taking about a 5% distribution. Another rule of thumb, if you want to replace income for 20 years, so a lot of young families, young kids, 10 times income should be enough to replace that income for a period of about 20 years. Other considerations: what one-time costs do you want to cover? Estate planning needs. If there's wealth transfer from a higher generation or to the next generation. Business continuation is something to consider as well, making sure that if you have a business partner that passes away, that you're not now business partners with their husband or wife. Making sure that the business continues without that revenue-producing partner. Also, which type of life insurance to buy. For every resident in here, really term insurance is going to fit the bill. For most, 99% of the time, with the option to convert it later on if you do need it for estate planning or tax diversification or asset protection as well. But in general, when you look at life or disability insurance, it's really important who you buy it from. Ross and I are both in wealth management, and what that means is we're not insurance agents. We are focused on the accumulation of wealth, and in managing wealth, a big part of that is making sure that that wealth is protected. So getting it from somebody in wealth management, I think, is important because we work on a fee basis, not a commission basis. So we have a fiduciary responsibility to provide recommendations that are in your best interest. That is, if you don't get in writing from your financial advisor that they act as fiduciaries from their clients, I wouldn't work with them. That is a really important thing to look for. Next, making sure that they are independent is really important. That independence is really important, not just that they have access to everything, but that they don't have any selling agreements with companies. Now, looking at outside risk, transitioning to the risk of other entities coming after your assets. This is a really important one as well. So looking at outside risks, the common objection of a young physician, once again, is that I don't have any assets to protect. Why do we even need to talk about this? But if you get sued, a plaintiff's attorney, once again, is going to look at your future income as a huge asset that they can come after. Now, with professional lawsuits, so malpractice lawsuits, typically, if you're an employed physician, the barrier that is created between your income and your professional liability is the entity itself that you work for. So if you work for a hospital, it's difficult, unless they can prove personal negligence in a suit, to come after your future income. Now, with that said, if you have 1099 income, independent contractor income, unless you establish that line with an LLC, those lines are completely blurred. And they still would have to prove personal negligence, but it's much easier to come after those things. Also, rental properties. A lot of you buy a house in training, and then you move, you keep it as a rental. You want to make sure that you're getting that in a separate LLC as well, so if a renter sues, they're less likely to be able to come after your future income. Now, more commonly, we see personal lawsuits. A few examples that I've heard about in my career, or have some clients that have gone through. One of our clients bought a big trampoline for the backyard. I wouldn't advise that, first and foremost. I remember my client asked me my advice on getting a trampoline. I'm like, you're calling your advisor for trampoline advice? I think you know the answer already. But ultimately, they were out of town on vacation. Neighbor boy came over, was jumping on it. They left a side gate unlocked. And little boy was jumping on it, sustained some bad injuries. The little boy's parents sued our clients and got a settlement. The example that Ross shared earlier, you're having a holiday party, you serve alcohol to your guests, somebody gets overserved and they're in a car accident, it's likely that you will get sued for serving the alcohol. They kind of lump everybody in there. So a couple of things that are free. In the state you live in, some of your assets will be protected from lawsuits and creditors. So usually there's some protection for 401ks, 403bs, and IRAs. 457s are typically not protected, and also not protected from the lawsuits and creditors of the employer. Certain amount of equity in your primary residence, cash inside of insurance policies or annuities sometimes has some protection as well. The inexpensive things you can do, the personal liability umbrella, that stacks on as a liability protection from any personal lawsuit above and beyond what you can get sued for in your home and auto insurance policies. So our client with the big trampoline, they went and gave 1 or 2 depositions and then washed their hands of it, and it was State Farm that was providing the attorneys to fight that entire suit. So they weren't out of pocket anything on that. An example of a client that did not secure that, client from Minnesota, northern Minnesota, and was in a car accident on his way to his cabin in northern Minnesota, hit a patch of ice, hit a car in oncoming traffic, and 3 of the 4 passengers died. This client of ours was getting ready to retire in about 5 years, and he did not have the liability umbrella policy, so he had to fund the entire suit out of pocket, not just the judgment, but in addition to that, the court costs, the attorney's fees, all that stuff. And now he's really going to have to probably work as long as he can. It's a really sad thing, but he really got cleaned out. And he was just overcome with grief from the incident on top of that. So it really is something that's totally avoidable. And you don't get it through somebody like us in wealth management. You get it through your home and auto insurance providers. For $1 million policy, it's like $200 a year. It's a no-brainer. Last thing that I'm going to talk about is tax and legislative risk. What is the highest marginal income tax rate in U.S. history? All right, B was the most common answer on here. Actually, nobody chose D, and that's the answer. After World War II, for a period of almost 20 years, the highest marginal tax rate was above 90%. And that was on any income above $150,000, which is the equivalent today of a few million. But that just kind of provides perspective. And then it was at 70 for a long time, and then at 50. Now we're at 39.6 is the highest marginal rate. Now, why do I bring that up in risk management? Well, I should have put on here as a slide, but does anybody know what the largest expense is in our federal budget? Healthcare, and more specifically, Medicare. Social Security and Medicare make up 60% of the federal budget. Every dollar our country spends, 60 cents of it goes to funding Social Security and Medicare. Now, why do I bring that up in a risk management or insurance talk? Well, one of the things to consider, baby boomers, that's the largest single demographic in our country's population, they just started turning 65 in 2011. Now they're turning 65 and starting to go onto these programs that were already broke in 2008. 2008 was our tipping point where less money was coming in for those programs than what was going out. Social Security, when it started, was an insurance on living too long. The average lifespan was 62, and you couldn't take benefits until you were 65. For every one person that was taking out from Social Security, 33 were putting in. Now for every one person that's taking Social Security, there's only 3 people putting in. So the program has to change. Social Security and Medicare have to change. When we run a retirement plan, a wealth accumulation strategy for our clients, we don't include Social Security. It will probably be there in some way, shape, or form, but it's likely to look different than it does today. Other impacts to you, if we're looking at your household budget and you're spending more than what you're making, we've got 2 options. You can spend less or you can make more. Well, spending less when it comes to those programs, number one, holds implications to your field. That could change the way that reimbursements are structured. We've already seen the RVU calculations change nationwide to more of a quality bonus instead of a production bonus. So changes to healthcare, changes to Medicare and Social Security for your personal planning. And likely that gap is going to be bridged mostly with increasing taxes. So the last thing that I'll say to kind of piggyback on the retirement planning is if you're not doing a tax audit on your investment planning and maximizing efficiencies in that with your current financial advisor, especially once you get into practice, it's possible that you're putting way more away than you would need to if you had a tax efficient plan. We recently changed not how much a client was saving, but where they were saving it. It's saving them now about 20 grand in taxes today, and it's going to save them about 50,000 per year in taxes every year of retirement. That's a huge deal when it comes to planning. Now, I'll wrap up with just a personal story. My wife and I were married in 2006, and when we started out, the focus for our planning was in accumulating wealth. And we had our disagreements about money. It really wasn't about where to save it. It was more about where to spend it. And it's mostly because I get physically pained when I have to spend money. My wife calls me cheap. I think I'm fiscally responsible, but whatever, neither here nor there. Though when we built our own plan, we know that we're on track to reach the retirement, the college savings goals, all those things. And after we had kids, it was a more impactful conversation because now we also know that there's a contingency plan if I get disabled. If one of us dies, that she'll be able to continue to stay at home with the kids. If we both die, we know who's going to be watching the kids, who's going to be managing the assets. It really is a bulletproof plan, both on the risk management and wealth accumulation strategies. And anything that's left over, total permission slip for us to spend. And that has been a really impactful thing for us. When we go on vacations, we go all out because we know it's money that we can actually afford to spend. That's the impact of planning. It's taking the sources of worry and stress in the financial situation and over time changing your finances to a source of comfort and strength. That's why it's important to do comprehensive planning and to have some help with it. But anyway, I've taken up my time. We'll open it up for questions in a minute. If you'd like to schedule a consultation with Anthony and I, and then the contact information is there as well if you'd like to reach out to us proactively. So, any questions?
Either of you could answer. How much money do you need to retire, whether you're a single person or a family? Are there any rules of thumb or calculators that you recommend for determining how much money you need before you can retire?
So there are a lot of misconceptions about how much you need to save to retire, because some people will come in with a specific number in mind. Hey, I heard I need to save this much to retire on, or they will think it's a variability of your income. So I need to save 7 times my income or 10 times my income to retire. Really what it comes down to is not so much your income, it's a variable more of your expenses, because in retirement, it doesn't really matter how much you made while you're working, it matters how much you spend, because you need to be able to cover those expenses in retirement. So the system that we use, there are some robo-advisors and things online that are okay, but the thing that they don't take into account very well is your unusually high tax bracket, your high student loan balances, and planning for young physicians is different than any other group of people, because the majority of the advisors out there and the information you're going to find out there, it's either the Susie Orman, Dave Ramsey's low income, low net worth, or it's planning for high income, high net worth. For young doctors, you are in a group that is high income and negative net worth. We send a congratulations Hallmark card to our clients when their student loan balance equals the money they've saved. So their net worth is 0, and it just says, congratulations, you're worthless. It's a huge day in our clients' lives. It's important to run an individualized plan with all those things to be considered, because that's not only going to tell you how much you need to save, it's going to tell you statistically the most efficient places to save it. And lastly, it's going to tell you the most efficient ways to manage your debt mathematically. So you've got a set amount of resources left over after your expenses every month, even when you go into practice. We're able to identify the most efficient way to divide that up and attack your debt and build your wealth at the same time. Yep, and that's a really big thing too, is your buddies that finished undergrad and went right into the workforce at 22, even though they're probably making less than you'll be making, they had another 10 years to save. It takes the same amount of time for $1 to grow to $2 as it does for $1 million to grow to $2 million. Those last doubling periods are hugely significant in your retirement savings. So getting started on your wealth accumulation right when you get into practice is of paramount importance, because the larger the snowball that's rolling down the hill initially, the more that you will have in the end. It makes a big difference. So it's a combination of what are your expenses going to be? When do you want to have the ability to retire? Do you want to have the ability to scale back at an age earlier than that? And then there's 100 more variables that go into it on the input side to achieve the desired outputs. Other questions? So the question was, the question was, are there policies that you can exclude pregnancy for? One reason to shop out your disability and life insurance through somebody in wealth management, number one, it doesn't cost you anymore to do so. And on life insurance, costs are less for females than men. There are no penalties for being female in that because you live longer. But on the disability insurance side, we have the ability to negotiate with underwriters. But about the only time they would do that would be if you have the inability to get pregnant. If you've had complications with a pregnancy, they're going to exclude it anyway, but they're not going to charge less, unfortunately. The asking for an exclusion on something like that, it would have to go pretty high up the flagpole to even request something like that. But I haven't really seen it before. Maybe some companies would be willing to do it, though.
When you talk about locking in disability insurance as a resident, what changes and what doesn't change when you move on to becoming an attending? I don't really understand those details. Do you mind explaining that a little further?
What was it? I'm sorry, it was kind of hard to. Was the question what changes once you go into practice?
Right. What does it mean to lock in your disability insurance as a resident, and what changes and doesn't change? What can you just go into flesh out a little more the details of that?
Yeah. So on an individual disability contract, the whole thing is contractual. So based on the way you were applied for it, the insurance company can never change your rates. They can never change your coverage. They can never drop you. That is a contract that they're obligated to honor. That's different from like a home and auto insurance or auto insurance provider. So nothing ever changes in the contract unless you change it. So you have the ability to increase coverage, but it is covering your specialty at the time of disability. So for instance, if you are school teacher and you apply for disability insurance, but then you decide to go to med school and become a radiologist, if you get disabled, you're disabled as a radiologist at the time of disability, so they're going to cover that. Even we have a client who was an anesthesiologist. She decided to be a stay-at-home mom, but she wanted to continue her disability insurance. Even though she's not making any money, if she is unable to be a stay-at-home mom, she will receive a disability benefit. So were there any other points of clarification on the specifics that you wanted with that?
So in the example of going from a resident to an attending, when you get your policy now, you're making whatever, like $50,000, and you don't change anything in your policy. If you come disabled as an attending, you're paying the rate as you did when you're a resident, but you would get your reimbursement would be you'd get back from your insurance as if you're disabled as an attending would be based on what you were as a resident or as when you're attending.
So the answer to that is it depends on what you decide to do. So if you never increase your coverage, you'll be paid the disability benefit you locked in while you're a resident. But usually what we do, once you transition to practice, we submit a pay stub or a contract, and they'll say, okay, now we're willing to offer this much. And you can take up to that amount or anything in between those amounts, but you have to proactively do that. And you're locking in the discounts of when you were in training, but it's at your attained age. So if you've aged a few years, then the cost is going to be a little bit more per thousand of coverage. Does that make sense?
Yes, thank you.
You're welcome. Yeah, the question was about backdoor Roth IRAs. The backdoor Roth IRA loophole was really designed for people to take their pre-tax plans, IRAs in particular, and convert them, so old retirement plans from work and stuff, and convert them to Roth. And the reason they opened that loophole was to try to generate tax revenue now and give the ability for people to pay the taxes on it now and never have to pay taxes on it again, regardless of where taxes go in the future. It was not designed for people that make too much to contribute to a Roth to be able to do that. So that loophole, that part of the loophole will likely be closed in the next year or two. However, while it's open, I encourage all of my clients to do it that qualify. Now, the caveat to that is if you have pre-tax IRAs, there's a pro rata calculation that you want to consult with either a financial advisor or a tax advisor on first to determine whether or not it makes sense. In other words, if you've got a pre-tax IRA and you do a backdoor Roth contribution, you're going to have to convert over a portion of that pre-tax IRA as well and pay the income taxes on it out of pocket. You can't have it withheld. Well, you can, but you're going to pay a 10% penalty on the tax. Yeah. Yep, absolutely. If you qualify for it, take it all the way to the bank as long as they'll let you. Unfortunately, it is a loophole that was on the chopping block last year. They didn't get around to it. This was an election year, so they don't get around to anything. And then maybe next year they'll get around to it. Hopefully they keep sitting on their hands.
So say you have your emeritus policy and you've maxed it to the amount you can as your resident. And you want to have that in place before you sign with your group. But you need to, where is the time period where you're transitioning from, say, fellowship to your group, where you increase it to cover, you increase your individual policy before you sign for your group policy? Because does your group policy, it's all of a sudden in effect the day you start your job? Or, I guess I'm trying to think of the best way to articulate it, because your original individual policy that you had during residency is still going to be at resident level.
Yeah.
So do you need to increase that before you sign your group contract, like to match your attending level?
Well, it's a little bit of a catch-22 because you're only offered the resident package, that while you're in training, that doesn't take any of those things into account. But if it's a $5,000 monthly benefit, tax-free, that's $60,000 that you get tax-free. That's equivalent. That's what they would offer somebody with $100,000 of income.
Okay.
So they're offering you more while you're in training that you don't really technically qualify for. And if you're in your last year and in the right specialty, you can get up to $7,500 of tax-free monthly benefit. But the hard part with it is once you transition to practice, or to be able to increase that, you have to have documentation substantiating more income. So either a contract or a pay stub or a tax return. And so they're going to take into account your group benefits.
Okay.
The way you can still increase it oftentimes, though, is usually with a group plan, there are two components. There's the percentage of income they'll cover and a cap on it. So they'll cover 50% of your income up to $10,000. So if you have enough income, and a lot of radiologists do, to substantiate an increase above and beyond that on your private disability insurance, that's how you're able to get more. So it's just based on a calculation that the insurance company does.
That makes sense. Thank you.
You got it.
All right, one more question about the Roth IRA.
Yeah.
So if your marginal tax rate as an attending is like 35 to 39%, do you still recommend investing in a Roth IRA or going to the traditional?
Yes. Both typically is. So once you get into practice, your highest marginal tax rate is going to be marginal, meaning if you're making more than $450,000 of income, let's say you're making $500, only the amount between that $450 and $500 is taxed at that highest rate, but that's the amount of a deduction you get when you do a 401k. So your average tax rate, your actual average income tax rate, is a blend of all those marginal rates. So generally, while you're in training, other than the match that you'd be offered through work, Roth IRA is going to be first and foremost priority. Once you're in practice, your pre-tax plans, you know you're saving that your highest federal rate plus whatever state rate you're paying on income taxes. But if you're just maxing out, it's a no-brainer to max out those pre-tax plans, anything that's available to you. The question is if you max out those plans, will it reach the entire retirement objective? And so if the answer is yes, then you can be done. But generally it's no. So where we look is what types of plans, if we reach deeper into the tax code, can we get some tax favorability on supplementing the retirement income above and beyond the pre-tax plans. But where we always start is what are the plans like Roth IRA, 401k, 403b, 457 that we can max out first and foremost to get tax benefits for low cost.
Okay.
So, but yeah, if you have the ability to do both, that's obviously a good thing. You're using your pre-tax plan to reduce taxable income in your working years when your income is at the highest, and you're using the post-tax plan to reduce your taxable income in retirement when tax brackets themselves will likely be higher.
So if you have an employer plan, but then you also want to do your individual IRA, you would do a traditional or a Roth, but based on your tax bracket, one would be more beneficial to you right now versus later.
Right.
So even if the higher tax bracket, you would still recommend doing a Roth if we can now, because that would be saving us money later.
Yep. Usually when we run the statistical analysis, it's called a Monte Carlo simulation, we'll run 3 or 4 different scenarios. Usually the one that wins is a combination of pre and post-tax because it's reducing your taxable income at every stage of your life, not just one or the other. Because if you do only pre-tax, you're deferring all of the income taxes to retirement when tax rates are likely to be higher. So yeah, it really is situation specific, but that's kind of in general the way that it usually will go.